Hello there, I'm Nick Clark. This is Counting the Cost on Al Jazeera, your weekly look at the world of business and economics. This week, a Saudi lollipop. That's how the kingdom described its move to unilaterally cut oil output in a bid to boost prices. But will it help to sweeten markets? Also this week, tackling Turkey's cost of living crisis, the nation's new finance minister vowing to return to rational ground in economic policies. Plus, more money will be going into clean energy than oil for the first time ever. We find out what's behind the boom in solar power investment. So, oil producers facing falling oil prices, and bets by Wall Street speculators could push prices further down. Saudi Arabia, the world's biggest exporter, says it wants to target those traders. It's announced it will cut output by 1 million barrels a day starting next month. The decision came after lengthy negotiations by the OPEC Plus alliance that saw other producers extend earlier reductions through to next year. Victoria Gatenby has this report.
Saudi Arabia's Minister of Energy arriving at the headquarters of OPEC in Vienna.
Your Royal Highness, are you confident there will be additional cuts today, sir?
After 7 hours of talks, the organisation of the petroleum exporting countries and its allies, including Russia, known as OPEC Plus, said they were cutting supplies of crude oil again.
We're hedging, but we're using the fundamentals to hedge. And we will continue to hedge as long as we don't see clarity and stability.
OPEC Plus accounts for about 40% of global crude oil output. Ministers agreed to extend cuts of 3.6 million barrels a day until the end of next year and said they'd reduce output by a further 1.4 million barrels a day in 2024.
OPEC is rightly, the ministers are rightly worried about the economic outlook, which is not too good. They're worried about interest rates rising, still in the US and certainly in Europe. So they're worried about a weak economy, and weak economy means weak demand, which is not good for prices.
In addition to OPEC's cuts, Saudi Arabia pledged to cut 1 million barrels a day in July. The International Monetary Fund says the kingdom needs an oil price greater than $80 a barrel to balance its budget. Energy analysts warn OPEC's strategy relies heavily on increased demand from China following the end of its zero-COVID policy.
The real question for me is around what happens if demand doesn't come through in the way that it's projected to, or if we see additional slowdown in the global economy, and then kind of what's left in the OPEC arsenal to respond to that.
During the talks, OPEC also agreed to increase the United Arab Emirates quota next year. African members, including Nigeria, that haven't met their targets had their quotas reduced. The price of Brent crude rose following OPEC's announcement of cuts, but the gains were limited because of doubts they won't be enough to stabilise energy markets. Victoria Gatenby for Counting the Cost.
Well, oil prices soared to more than $120 a barrel last year. But as we can see here, they've dropped back to levels seen before Russia invaded Ukraine. That's despite the reduction by OPEC Plus of nearly 3.66 million barrels a day since October. A production cut announced in April sent prices up close to $87, but the price boost did not last long. International benchmark Brent crude fell to nearly $70 a barrel at one stage, more than a week ago. It jumped slightly up to more than $76 per barrel after the latest announcement. Let's take this on. Joining me now from Dubai is Robin Mills. Robin is the Chief Executive Officer of Kamar Energy. Robin, welcome to Al Jazeera. What do you make of the market reaction to Saudi's decision so far?
Well, pretty tepid, really. Not much price action, a little bit of a gain, but nothing significant. I think, indicative of where the market's mindset is, that it's pretty bearish, pretty gloomy about the demand and economic picture, and supply cuts haven't helped shore up prices, really.
Right. So, and where do you think it's heading? Do you think that will change?
I think it will, but it really depends where the economy is going. And I think if the economic outlook is reasonable, demand is reasonably strong, all the forecasts would show the second half of the year a significant deficit and prices going up again. And that's where the OPEC cuts would really start to have effect. But I think the market is still very much on a negative mindset that the general demand forecasts, if you look at OPEC forecasts or International Energy Agency or others, that are all too optimistic because the market's kind of foreseeing a weaker second half economically and looking at all the risks to the global economy, softer output in China, various US debt crises, bank crises, and so on.
The Saudis seem pretty determined, don't they, to make this happen, sacrificing market share to push prices up. I mean, how long can they keep on going, sustaining these kind of cuts?
Well, I think it's difficult because at the latest round of OPEC talks, of course, the Saudis have been the only ones to volunteer a cut. And, there's been just some quotas and so on, but that only comes into effect next year, and it's kind of notional anyway for most members. So the Saudis are the only ones cutting. Now, if by the next meeting the prices and the market still isn't where the Saudis want, would they want to volunteer yet another cut, a unilateral cut? And then the other side of this, of course, is Russia, which also promised to cut in April. And the data's pretty hazy, but it doesn't seem that the Russians have cut production significantly.
Why do you think it's been so difficult to stabilize the markets?
I think just because of the mindset, we continue having negative economic news. We had the collapse of some US banks, then we had the US debt ceiling talks. Okay, that's behind us now. And we've been watching China, the Chinese reopening post-COVID very carefully, but the latest Chinese export figures are not very good. So I think the market is just in a mindset that a recession is coming, weaker demand is coming. The major agency forecasts are over-optimistic, and the demand in the second half will be a lot weaker than is foreseen. And therefore, all of these supply cuts, 500,000 barrels a day here, 1 million barrels a day there, still don't add up to enough to give a bullish narrative. And that could swing around quite suddenly. The market has moods, and it may go into a more bullish mood if the economic data starts supporting that.
Of course, the IMF says that the Saudis need the oil price to be at $80 to finance its budget. Do you think that's the kind of price floor that's targeted by OPEC Plus?
Yes, I mean, obviously, if the oil price isn't at $80, and it isn't right now, Saudi can still carry on with its plans, but it will obviously run a deficit to do so. But I think a price, currently around a price around 80 would look reasonable. It would make the OPEC members, and including Saudi Arabia, feel a lot more comfortable.
Outside the world of those trying to intentionally push prices up, your average person would have little sympathy for the big oil producers with record profits all around and so forth.
Yeah, well, I mean, this is a market in which OPEC has a lot of power, and OPEC has a lot more power today than it did a few years ago because of lower production, or at least lower production growth elsewhere. And it's there's a complex balance, and OPEC countries are also looking out for their own interests. At the same time, obviously, the US and others would prefer prices to be lower.
You mentioned Russia and their position in all of this. Generally speaking, are they in line with the policy, do you think?
Well, they're in line with the policy where Saudi Arabia cuts and helps support prices, and Russia doesn't have to cut, yeah. But I think Russian production has gone down, of course, since the start of the war. But not really voluntarily. It's because of sanctions and difficulties exporting Russian oil. The Russians promised a voluntary cut in April. Doesn't really seem that they've delivered on that. And I think if by the next OPEC meeting it still seems the Russians haven't cut significantly, it'll be a much harder conversation. The Saudis will have to say we're not able to continue these cuts if the Russians don't join in, because that was the whole point of forming OPEC Plus. It was to get Russia and some other important non-OPEC countries inside the tent and have them making at least some cuts to support collective action. And that worked very well at the start of the COVID pandemic when all the countries cut significantly. It doesn't seem it's working so well now.
What about those short sellers, the speculators that the Saudi says it wants to target? Is it going to hurt them?
Well, I mean, the bump in prices wasn't very much, so I wouldn't expect so, no. People with large short positions will still feel that that they're still justified. That the price has only gone up slightly, and there's still room for further falls. So we didn't really see a major jump in prices. That the market wasn't particularly shocked by the outcome of the meeting.
Observing all of this going on, what about the United States? How will they view it?
I think the US will feel reasonably comfortable here. The price is not too high. It's not too low either, and obviously the US is a huge oil producer, so it's always balancing the interests of oil-producing companies and oil-producing states against consumers. I mean, it would prefer on balance that prices are lower, but not too low. And prices are in the range or getting towards the range the US could think about refilling its strategic petroleum reserve which it briefly thought about a couple of months back. It didn't seize the opportunity, but it has a chance now.
Robert Mills, great to get your perspective. Appreciate that. Thank you.
Thank you.
Now, prices in Turkey have rocketed over the past 2 years, with inflation hitting a 24-year high in October. But despite that, President Recep Tayyip Erdogan has refused calls to increase interest rates to bring prices down. There is a new Treasury and Finance Minister. He's popular among foreign investors and will now be tasked with fixing the economy. Could Mehmet Şimşek reverse Erdogan's unorthodox policies? Sinem Kosioglu reports from Istanbul.
The Tasty Smith, or the Turkish bagel, is the most affordable street food in Turkey. But the price of the Turkish breakfast staple has increased fivefold in less than 2 years. That's a result of the government's unorthodox monetary policies that have led to a sharp decline in the value of the currency. Now, President Recep Tayyip Erdogan has reappointed his former Orthodox Economy Minister Mehmet Şimşek. His job is to whet the appetites of the markets following Erdogan's presidential election victory last month. But some are skeptical.
Although much of the uncertainty has been removed, the fact that those who took office were dismissed after their actions were praised by the markets remains a source of concern. So how much certainty will there be in this regard? The markets are now questioning whether this appointment is being made in preparation for the local election that's scheduled for March.
Under Erdogan's influence, the Turkish central bank slashed interest rates over 2 years, aiming to boost growth through exports. The lira lost more than 90% of its value in the last decade, following a series of crashes, the worst less than 2 years ago. During a handover ceremony, Şimşek said Turkey has no other choice than to return to what he called a rational ground, prioritizing a rules-based, predictable national economy to ensure prosperity.
So long as you have an independent central bank, and so long as your central bank believes in orthodox policies, there is a way to get out. What we don't know for sure is how much independence they are going to have and to what degree they will be able to implement these orthodox policies.
Despite the failure of what President Erdogan described as the new economic model, he has reiterated his desire to bring interest rates down.
From his minister days, Şimşek is known as a stringent economist. With the election left behind, what is called the campaign economy is over in Turkey, and he is expected to press on with austerity.
Turkish citizens are already suffering from high inflation, a devalued currency, and a cost of living crisis. Now they are being told that to overcome them, they'll need to further tighten their belts along with the government. But many are waiting to see if President Erdogan is being sincere when he says he's granting independence to his new economic managers. Sinem Kosioglu for Counting the Cost, Istanbul.
So how does Turkey's $900 billion economy shape up? Well, inflation has nearly halved since its peak of 80% last year. But the Turkish lira lost nearly 70% of its value against the dollar in the past 5 years. Attempts to prop up the currency and finance an account deficit have depleted foreign currency reserves. Turkey's economy expanded by more than 5% in 2022 and grew more than expected at the start of the year. But analysts say that growth could dip in the coming months. Well, from Istanbul now, I'm joined by Nilüfer Sezgin, who is the chief economist at IS Asset Management. Nilüfer, great to have you with us. Thank you for joining us here on Al Jazeera. So we have this guy, he's highly regarded in the financial world. He himself has pledged a return to rational economic policies. What does he mean by that? And will he have a free hand to do so?
I think this is a very good question, because back in 2020, we had an episode where the central bank governor and the economy minister were changed, and that change was accompanied by policies that are more, that were including more rational actions. The central bank stopped, for instance, intervening in the FX market, inflation targeting become an objective again. and we saw some monetary tightening. However, this didn't last long, and after that, the economy policymakers became committed even more to the so-called new economy model and unconventional tools. So it's very right to ask whether Şimşek will be able to deliver what he's intended to. But I think this time it's a little bit different because now the policymakers have the chance to observe the outcome, the results of the new economy model. And it appears that there are some more significant constraints to keep the new economy model up and running. So they had a second look at this new economy model, and now both they have to change it, and they believe that there's a good reason to change it because the new economy model, unfortunately, it couldn't lead to better trade performance, trade balance, better export performance, and a reduction in import dependency. So I think this time it's going to be different. And,
right, but it's a fine line for him to tread, isn't it, for Şimşek to tread, because his boss, the president, is known for the fact that he thinks that high interest rates are the cause of high inflation. So what can we expect, do you think, in terms of interest rates?
Yeah, I think the interest rates will be hiked because if you look at the news flow that was circulated when first Mr. Şimşek and President Erdogan met, the unnamed AKP officials were claiming that there will be going back to orthodox policies, and if that necessitates an interest rate hike, that will be the case. I mean, if that is needed, then interest rates will be hiked. And also, I combine this with Şimşek's own explanation, own emphasis on rational policies, predictability, rule-based economy. So I think this will include an interest rate hike. And at the next meeting, we will probably see a hike in interest rates.
And what about the lira? What's he going to do about that, and also for the country's depleted reserves?
Yeah, the most important thing, the most important issue to tackle in the first place is the FX reserves, actually, and to restrict or lower FX demand. And in order to do that, with the monetary tightening, I think there will be a slowdown in loan growth. The economy will slow down. So this will lead to a lower import demand. And more importantly, the currency is going to depreciate probably. We already saw some depreciation, but I think there may be room to go more. And it's going to be, quite contradictory because at a time when monetary tightening is happening, you normally wouldn't see the currency weakening. But the fact that the central bank will allow the free market to determine the exchange rate rather than by, intervening in the FX market, that will lead to a higher interest rate and a higher exchange rate at the same time. And a higher exchange rate will also allow some adjustment in the external deficit. So overall, this will probably lead to this will contain FX demand. And also, this is not going to only help the external deficit side. This will also help local investors, residents, to probably at first stop accumulation of hard currency. And then at some point when the currency and interest rates are at more fair levels, then at some point they may decide to go back to Turkish lira savings.
Bottom line, and briefly if you would, is he the man to fix the economy?
Yeah, I think so, because there is an available background for that. As I said, the local investors are very much dollarized. We don't have much foreign investors. The foreign investor positioning in the Turkish market is extremely low compared to historical standards. So I think as soon as the Şimşek team, Şimşek and his team proves that they're delivering what they promise, I think there will be some increased confidence, which will attract foreign investment and which will convince local investors to go back to Turkish lira. So yes, in the medium term, we need some structural reforms, some changes in tax policy, education, etc. But in the short term, there is room for enormous improvement, even with implementing basic economy principles.
Just great to get your analysis. Thanks very much.
Thank you.
Now, nearly $3 trillion is expected to be invested in the energy sector globally this year. But for the first time, it is anticipated more money will be spent on solar power than on oil production. The International Energy Agency says at least $1.7 trillion will be invested in sectors including renewables and electric vehicles. The rest will go to oil, gas and coal. So let's break down the figures. At least $1.7 is now invested in clean energy for every dollar spent on fossil fuels. The ratio was 1-to-1 5 years ago. Solar power spending is leading the increase. It's expected to reach more than $1 billion a day. That's nearly $380 billion this year, while more than $370 billion would be spent on oil production. But investment in new fossil fuel supply will rise by 6% this year. That's still double the level it needs to fall if the world wants to reach net zero emissions by mid-century. Well, Dave Jones is joining us now from London. Dave is the Global Insights Lead at the Ember Climate Organisation. So, Dave, first up, how significant is this shift in investment and what's driving it?
Yeah, it's a very significant amount of investment going on to clean investment. It averaged about $5 billion a day globally last year. And it was the 6th year in a row that clean energy investment globally was bigger than fossil fuel investment. Clean investment, it covers a wide definition of things. It includes things like energy efficiency, nuclear power and electricity grids. But the 4 technologies that really led to so much of that growth were solar power, wind power, electric cars and heat pumps. Electric cars have been on a real tear with sales up by 1/3 last year. And in terms of what it's been driven by, so much of it has been driven by positive government policies, but so much as well has been driven by consumers who want to buy electric cars and want solar panels installed on their roofs.
And solar is very much a driving force in all of this, isn't it? Why is that?
Yeah, the IEA led with a headline about solar investment overtaking oil investment for the first time. So in the context that oil is the dominant fossil fuel, and now solar investment has leapfrogged into that, that really positions solar as a true energy superpower. I guess it's particularly pertinent when you try and link the two together, when you look at those, the biggest amounts of clean investment which are coming through, which is in solar power, followed by electric vehicles. And you can see that in the old economy where you had oil powering fossil cars, you've now got solar being used to power electric cars. So there's a real connection between the two.
It's pretty evident then that the clean energy industry is very much emerging, but it's not being helped, is it, by the fossil fuel companies? In fact, quite the opposite.
Indeed. So their got investment is up again last year and this year, which is not so good. The calls from Fatih Birol on that, the head of the International Energy Agency, when he launched his work on clean investment, he had a really pointed message towards those companies that were investing into new fields, which was that change is coming fast. And when you look at that clean investment coming on, that clean investment into renewable electricity is coming on with a zero marginal cost. It's not increasing the overall demand for energy. What it's going to be doing is it's going to be displacing the need for fossil fuels. And so far, it hasn't quite reached that critical point. At the moment, so much of that clean investment is just driving general investment into energy and the general demand in energy. But it's starting to increase to the level where it's actually going to start reducing fossil fuels. And in the next couple of years, that might be quite slow. Later on in the decade, that's going to be extraordinarily quick.
Right. So how far are we away from a clean energy economy? And is it going to happen quickly enough?
How far are we away? It depends on in part on where you live. So although that story on clean investment is a really positive story, in the case of emerging countries outside of China, on average, they have got the same amount of clean investment that they had back in 2015. So much of that driving force in clean investment has been in OECD countries. It's been in China, and it's left a lot of emerging countries a bit behind the curve there.
Still some way to go. All right, Dave Jones, appreciate that. Thanks very much indeed.
Thank you.
And that is our show for this week. If you'd like to comment on anything you've seen, you can tweet me at Nick Clark Al Jazz. Please use the hashtag AJCTC or just drop us an email. counterthecost@aljazeera.net is our address. Plenty more for you online at aljazeera.com/CTC. That will take you straight to our page, which has individual reports, links, and indeed entire episodes for you to catch up on. But that's it for this edition of Counting the Cost. I'm Nick Clark. From the whole team, thanks for joining us. The news is coming right up.